Ladies and gentlemen, thank you so much for joining us for this week's episode. In just a moment, we're going to have an exclusive full-length interview with HighTech Lending CEO and President, and also their Executive Vice President of National Sales. And we're going to be looking at the latest innovation in senior lending, Equity Select. But before we do that, we have some breaking news. We may have the new HECM limit. That's right, the new HECM limit for 2026. And so for that, let's go to the website of FHFA. Last week, shortly before the Thanksgiving holiday, the Federal Housing Finance Agency announced on the 25th of November that they have a new conforming limit for 2026. It'll be $832,750. And what does that mean for us? As we know, the home equity conversion mortgage, or HECM limit, is based on 150% or 1.5 times the conforming limit that is set by the Federal Housing Finance Agency for one-unit properties. So taking the 2026 conforming limit and multiplying it by 150%, the new HECM limit for 2026 will be $1,249,125. So that's where we stand today, the new HECM limit for 2026. The formula for the conforming limit was established by HERA, or the Housing and Economic Recovery Act of 2008, and it mandates that the baseline conforming limit be adjusted in step with changes in the HPI, or the Home Price Index. In short, FHA looks at the nominal seasonally adjusted expanded area data for home price index, or home price appreciation, for the third quarter of the prior year, and then measures the difference, or a percentage change, for the third quarter of this year, of 2025. And so for 2026, the HPI change covering the third quarter of 2024 to the third quarter of 2025 was approximately 3.26%. Now, while that gain is modest, of course, we do see it reflected in the new HECM limit for 2026. In short, next year, of course, you're going to want to let your clients know that the 2026 HECM limit has increased. Perhaps a good time to reach out to those in your database who maybe didn't qualify or are just on the cusp. So with that increased limit, especially those with higher mortgage balances, this could be the time where they may qualify. Now on to our interview with HighTech Lending, and we're going to be looking at the Equity Select. So let's dive into this full-length interview, and right after that, we have an update on the new Medicaid premiums for 2026. A few weeks ago on this podcast, we covered HighTech Lending's newest offering, that is the Equity Select, which interestingly is not a reverse mortgage. I have to remind myself of that, but it is an alternative to the standard HELOC for older homeowners. So joining us today is HighTech Lending CEO and President David Peskin, and also Executive Vice President of National Sales, Eric Ellsworth. And they're going to tell us what led them to develop this new innovative product and its part in the evolution of senior lending. Gentlemen, thank you so much for joining us.
Eric and I have been in the space for 20 years dealing with the older demographic. And we continue to believe that there's a really big void in the market, either for those that are entering or in retirement. There's roughly 40 million homeowners over the age of 62. And if you break that down, roughly 16 million have a first lien. And what's interesting is, of that 16 million, around 11 million have a note rate below 4%, right? So they've got really low rates and likely don't want to touch it. The problem is that with homeowners insurance and real estate taxes rising along with everyday living expenses, as we've seen, it's more and more challenging for older homeowners to tap into the equity and be able to age in place. In fact, if you go back to some historical data, given that they're on fixed income, 50% of those have applied for a HELOC or a second lien were declined just due to DTI. It's a big number. And then if you look at a traditional refinance, whether it be a cash out or just a rate and term, it's upwards of about 39% don't qualify just to DTI. What's interesting, though, is that the average LTV is 30%. So the risk is really low, but yet they're not qualifying purely due to DTI. So there's a big market. A lot of people need to get access to the equity in that home, and they're not qualifying due to DTI. So we've got a great asset. So how can we create a product that can help fill the void in this market in a bigger, broader way? And we look at sort of asset-based lending, right? We've got a lot of equity, and if we can create a product that is going to give people access to the equity based on a low LTV and some other measurement, then why not do that? And we looked at products and we felt that a HELOC, which is recognized by most older homeowners as a safe and secure product, if we could just recreate it in a way that makes sense, there's a big market. So most HELOCs today are designed with a 10-year window of interest only. And then after that, that loan recasts and the payment can get very challenging for an older homeowner. We designed it where you can actually pay as low as 1% of the outstanding balance paid monthly, which allows for a really low flexible payment. And the reason that we can do that is because we do it based on life expectancy. We set an LTV based on life expectancy. So the simplest way to think about it is everyone gets a credit card statement in the mail. They can make a minimum payment. If they don't make that minimum payment, or if they choose to make the minimum payment, any interest gets added to the balance, but they have the option to make any payment they want. So it's designed very similar to that. And what's also unique is that we've got a lifetime cap payment. And this payment is a low payment. That allows us to qualify the borrower using that payment. So let me give you a perfect example. We looked at a 74-year-old borrower who had a first lien. They had $4,500 of fixed income. And we ran a Pepsi challenge, our own Pepsi challenge. So we looked at a traditional HELOC versus the equity select HELOC. And the HELOC that the bank would have qualified the borrower for $33,000 based on their DTI with a cap payment with a payment of $260. That's how much room they had. So we took the same $260, which would be our cap payment, and that qualified the borrower for up to $200,000. So that's a substantial difference. You're now giving someone access of $200,000 with the same cap payment of $260 for the full 40-year term. And remember, they don't have to make $260 payment. That's the minimum they have to make, any payment they want, but they have the flexibility to go as low as the $260 payment.
And you have the bonus of not having the senior homeowner experience payment shock, which is common with a HELOC after the loan recast after the draw period and becomes fully amortized.
That's right. Look, I don't think people are always just looking for the no payment. I think at the end of the day, they were looking for flexibility. We're seeing credit cards balances, $25,000 to $75,000 balances out there. And why? Because it's the only access they have to funds, and they make the minimum payments. And it's difficult because they're paying in the 20-something% range. This gives them the same flexibility, just using something that makes sense, the equity in their home with a lower interest rate.
And I think you're right, Shannon, having the non-recast so they don't have the payment shock. But in addition to that, non-recourse, right? So I know a lot of your viewers are reverse mortgage industry vets, and we felt it important to have that feature with this product as well.
So how do you see the Equity Select fitting into the broader landscape? Because you have a reverse mortgage presence that we know you best for with HighTech Lending and American Senior. How do you see this fitting kind of in your decision tree, so to speak, in the sales process within your companies?
So definitely a HELOC, right? This is the HELOC bucket. It's not a reverse mortgage, and it's a different kind of customer. It's somebody that wants to tap into the equity of their home, but maybe they don't want a reverse mortgage. Maybe they've heard some things. There's obviously some perception issues with that product, and they trust a HELOC. So we surveyed. We surveyed. I was going to go back to what David was mentioning. Some reverse mortgage customers, about 60 in a room, and it was interesting because one of the things when we showed them this product, they said, "Can I refinance out of my reverse mortgage into that product?" And we said, "Why? You're in the Cadillac, right? You've got no mortgage payment right now. You've got an FHA. Most of them were FHA reverse mortgages." And what was interesting to uncover was they came out and basically said, "Look, it feels reckless not making a payment every single month. So it would be nice to at least make some type of a payment, even if it's just a small payment like it is on Equity Select." So this really fits into the HELOC bucket. Something that people know, something that people trust. We go off Fannie Mae guidelines, no FHA appraisals. And as David mentioned, we go off that capped payment so more people can qualify for this product.
So I'm curious, what was the investor appetite for this loan as you were developing it? And can you speak to how they received the product once you had designed it?
We've got a tremendous investor base interest, both in the first lien and the second lien product. I think people recognize that this is clearly an untapped market, and people, as they age in place and want to remain at home, are going to need access to this equity. And they thought that the product was really well designed. It made a lot of sense. There's a lot of security around the way it's designed, given the cap payment and the LTV. And I think there's a lot of excitement around it. And obviously, we're excited about it.
This year, we've seen several new product offerings from reverse mortgage lenders. So, how does Equity Select differentiate itself in the marketplace, and what are the advantages for the senior homeowner?
So it's really the flexibility in the payment, right? So when we set out to create the product, it was how can we give them access to the most dollars with a flexible payment, with the lowest possible payment. And a lot of times, for those of you that have been in the industry for the mortgage industry for a long time, back in the early 2000s, there was a loan called the pay option arm or the pick a pay mortgage back then. And clearly that product had some design flaws, right? We were loaning way too much loan to value. The payment would recast after 110, 115%. We believe we've fixed that with no recast. So the payment, there isn't going to be that payment shock and having the capped payment and non-recourse features like that. But it's really the payment, right? We had a client on the retail side of the business that one of our very first customers, they were turned down for a $200,000 home equity line of credit. The payment on that was $1,250 a month. That was their interest only payment. $1,250 to borrow $200,000, which, as you could imagine, for this demographic, can be, not many of these clients could shoulder a payment like that. They qualified for, get this, $800,000 on Equity Select, and the payment was half the amount. The initial payment was just $667 a month. So, really, it's the lower payment and the payment cap that really makes this product stand out.
Yeah, I mean, look, it's designed to give the maximum flexibility to older homeowners so that they can access the equity in their home. And most people understand what a home equity line of credit is, including 98% of the forward mortgage market who is using a forward LOS. So they can go right into their existing LOS, originate a loan with us, and we make it simple and easy to do. And we also provide a web calculator so that they can understand exactly what a client qualifies for right online within seconds, whether it's a first lien or a second lien. So, we're really trying to, again, fill that void in the market, but make it as easy as possible for anyone to be able to originate the loan.
And I think there's two sides, real quick, Shannon, on this, right? You've got somebody that maybe in the market, right? Loan officers now, especially on our wholesale side and our retail side, they're going out, they're marketing Equity Select, which is a home equity line of credit with an ultra low flexible payment, like David mentioned. And it's giving them the ability to talk to more people that maybe wouldn't have talked to them if they would have marketed a reverse mortgage. And it's opening up the door, actually, where somebody comes in and they actually end up walking away with a reverse mortgage to somebody that maybe we never would have spoke to. And on the flip side of that, we've got a lot of reverse mortgage customers that are coming through our reverse mortgage marketing that, we just had a scenario where the client said, my kids don't want me to get a reverse mortgage, right? Whereas in the past, if a client said that to a loan officer, the conversation would just stop, right? It wouldn't continue any forward, to move forward. The client would continue to suffer and not tap into the equity of their home. Thankfully, Equity Select gives them an alternative way to tap into the equity of their home. In that case, their kids didn't want them to get it, so they walked away with Equity Select. So I think it's nice to be able to offer both products and to speak to more people because, you don't have the perception issues of a reverse mortgage, the term reverse mortgage.
Well, this loan sounds like a win-win for both the homeowner and the originator or broker. I have a quick question about the role of technology, which is becoming increasingly important in the underwriting process, and how it's going to impact the speed to sell of the Equity Select product.
That's what's exciting. The forward side, David had mentioned this, that we built it on forward technology on purpose. And a big reason was the automation on the forward side. Technology like Plaid and things like that allow us quicker access to the client's financials. So we're building all that, we're automating it. The good thing is the transactions, all the transactions we've done so far have been between 2.5 and 3 weeks from start to fund. So the speed to transaction on the traditional mortgage and HELOC side is generally faster. The loan officer likes that because they get paid faster and the client appreciates that as well. The proprietary tool that David was mentioning is also an underwriting engine as well. So it automatically calculates the debt to income ratio and qualifies the client for the maximum amount based on how much they get in their how much proceeds they can get at closing. And we have things like dissipation, so asset dissipation, which the reverse side is familiar with. The forward side is not as much. We're having to teach them, but asset and proceed dissipation, which the calculator does all that for the loan officer.
David, I'm going to put you on the spot here for a moment. Do you anticipate HighTech or American Senior Lending launching any new products in 2026?
So look, we're always going to be looking at new products and new opportunities to fill the void. I think when I think about 2026 and the opportunity we have ahead of us just with Equity Select, it's a big market, especially since we're rolling out our second lien version towards the end of this year, going into the first quarter. So there's a really big runway. Being in the reverse for so long and having challenges getting into banks and credit unions, financial advisors, insurance agents, et cetera, really limited the market. Now we have a product that we can roll out to all of the forward lenders, banks and credit unions. We're getting a lot of good feedback from people in the financial world, people who are, if you think about how home values have skyrocketed in certain areas, and the average older homeowner might be in that home for 20 or 30 years and has millions of dollars of equity. If they were to go sell that property today, they'd have tremendous capital gains. Yep. The problem is if they can't afford to stay in the house, it doesn't really benefit them. A product like this can allow them to remain in their home. Financial advisors are comfortable talking about a HELOC product with flexibility, and then they can stay there until one of the spouses pass, and then they've got that step up in basis. So there's a huge increase in inheritance that they can live for their kids. And then there's the long-term care aspect, right? Fund the long-term care policy with a second lien, again, with a HELOC product that gives you the flexibility in the payment. So when we talk to loan officers on the forward side, they get it right away. It's a HELOC, right? Just with flexibility in payments, and they understand payments and how to qualify people. So a lot of thought and energy has gone into the design and development around this. So we're really excited about where we're going.
Gentlemen, thank you so much for joining us. We look forward to the role of Equity Select in senior lending. We'll be watching that in the future. Housing Wire reports that Medicare Part B premiums are slated to increase by 10% in 2026. And of course, that's going to erode Social Security benefits by just a little bit. For more details, we go to Housing Wire. It looks like in 2026, Medicare Part B premiums will exceed $200 for the first time. And the cost refers to Medicare Part B premiums, deductible, and coinsurance rates. And those are determined according to provisions of the Social Security Act, reports Reverse Mortgage Daily and Housing Wire. So Part B covers physicians, outpatient care, and certain home health services and durable medical equipment, among other services. The new premium will be $202.90 in 2026. That's about almost $18 higher than it was in 2025. And the annual deductible will increase by $26 up to $283, according to the Centers for Medicare and Medicaid Services. Now, one of the driving forces behind the increase in the premium for Part B Medicare is quite interesting. It's related to spending on skin substitutes, according to the Trump administration, and that was to address that increased cost. So spending on skin substitutes is expected to drop by 90% without affecting patient care, said the agency. So it looks like they're trying to cut costs while keeping the premium increase to a minimum. Compared to just a decade ago, do you wonder just how much Medicare Part B premiums have increased? Well, Housing Wire reports that they have increased by 66%, while deductibles have increased by 70.5%. Against this backdrop of the Medicare premium increase, we will actually have a 2.8% cost of living adjustment, or COLA, that will increase Social Security benefits in 2026. And now it'll average about 14%. That is, the Medicare premium will average 14% of the average monthly payment that one receives on Social Security. And the average benefit for Social Security is expected to be about $2,056.